Hello and welcome to the episode of Mutual Fund Masters. Joining me today is Chandresh Nigam, who's the Managing Director and CEO at Axis Mutual Fund. He's a industry veteran, been around for more than 2 decades. Thank you very much, Chandresh, for joining me here in these difficult times. Hopefully things could be better, but we've gone through a lot of misery. But my first question to you, recently, the data showed, emerged as the leading mutual fund house when it came to an equity asset under management, or AUM as you call it. What has been the philosophy of the fund house to be able to emerge in such a focused manner on equity?
I think the lot of the credit for the way this whole business has grown goes to our very differentiated approach, which we have had at Axis Mutual Fund right since our inception. We started this business just after the global financial crisis about 11 years ago. And we always thought that what we will have to do has to align with investors' interest from a long-term perspective. And what is that? It's about institutionalization. It's about investing in sustainable strategies. It's always ensuring that you have high quality in your portfolio. That's the surest way to cut down risk in the markets. As we all know, equity is a high risk asset class. And most importantly, after having done all that, you also need to invest in and ensure that you have proper risk management, because things will at times go wrong. And that all that holistic approach to managing money did obviously take us some time to prove that this kind of an approach ultimately gives much better outcomes for investors.
From a equity portfolio construct point of view, what would be your advice to a first-time investor at this point of time?
So the first-time investor, whether it is this time or any time, is that you must get in with a good understanding of what your risk profile is, and then figure out what is the total amount of money you want to invest in equities. And initially just look at a large cap diversified fund, because that's where the risks are the lowest. Large cap diversified fund investing in high quality, good long-term sustainable growth businesses, strong businesses essentially, which have the power to sustain the downdrafts which come all the time. Right now we are obviously in one. And then build up that asset allocation over a period of time. Since you said this is about a first-time investor, look at the next 6 months or so to build that asset allocation. If you think you want to be 40% in equity, then that is equal to, let's say, X amount of rupees. Then over the next 6 months, divide it into maybe 7 or 8 tranches and invest in a couple of these high-quality, large-cap diversified funds. So that's the way to build the core of the portfolio. And then once you get more accustomed, more used to investing and more used to some of the ups and downs which will anyway come, then it will be time to look at some of the other asset classes, maybe more focused funds or mid-cap funds, or one very important diversification, which is international funds. Because as we all know, diversification reduces risk, and global markets again have enough and more wealth creation opportunity.
Recent data showed, Chandresh, that less than 10% of the SIPs in equity schemes were carried on for even 5 years. How important is it to remain invested for a long time if you want to get the true measure? I mean, if you see your own fund's track record, there are several schemes of yours which have given phenomenal returns over the last decade and more. And yet, people tend to want to exit fairly early on in their investment journey. What is your advice to investors on the importance of long-term when investing in equity?
And our analysis in India shows over the last 10-15 years, investor returns lag fund returns by a good 5-6%. That compounded over a 10-year period means that investors are probably getting in only half the performance, or able to participate only in half of what the funds are in. And the only way to really take advantage of what the funds are able to generate is to just stick to them for the long run.
Chandresh, the last couple of months we've seen positive net inflows, into equity funds. Though there was a decline in April vis-a-vis March. But do you see this trend continuing, or do you foresee some pain coming ahead in the next few months?
So, Vivek, if you look at, let's say, the trends over the last 4-5 years in equities, I think we've normally had reasonably solid positive flows. And I think post-COVID negative of about 6-7 months was an aberration. And it was an aberration for two reasons. One is many investors did want some money back because there may have been job losses, cash flow problems, small businesses having problems in terms of access to credit, etc. Second, there was a big worry on part of the investors that while the SIPs largely were continuing, the lump sum business kind of stopped. People were saying, okay, let's wait and see how this whole thing kind of plays out. I think November, December onward, we had started to see some change in trends. SIPs being nearly 50% of the flows, then the lump sum started to go up, and now SIPs are probably 1/3 or less than 1/3 of the flows. So lump sum activity has started to come up, and it's become large enough for the overall number to become a positive.
Chandresh, what are you and your fund managers bullish on as far as sectors are concerned over the next 3 to 5 years?
Top down, we know that there are a few sectors where they are more to find. Anything which is consumer-oriented, B2C kind of a business, whether it is a discretionary or a staple business, I think there is good value. Brands drive profitability and pricing power, so that's one area. Healthcare is one good area right now. IT is a great, especially after COVID, the entire world has moved to online, and companies need to move their product offerings and innovation and engagement models online. So that's a lot of activity happening with massive amounts of work and hiring going on in that space. So those are the three top sectors. And then playing the consumer theme, you could look at automobiles, for example, select automobiles. You could look at people building to now trend towards bigger houses, etc. Select parts of real estate. I know it looks a little contra right now, but I think long-term trends are in favor. The cement sector. There are a number of sectors which we feel, and more importantly, companies in these sectors which we feel will really do very well over the next 3 to 5 years.
All right, we leave it there. Thank you very much, Chandresh, for coming by in these difficult times and sharing your perspective with our viewers. I wish you all the very best. Thank you once again.